As of 10:53 a.m. Eastern Time on this Monday, November 17, 2025, shares of Quantum Computing Inc., ticker QBUT, are trading at $11.99 per share. That is a significant intraday surge, up $1.39 or 13.16% on the session. Volume is absolutely explosive, already trading over 32 million shares, which crushes its own daily average. Now, the immediate reaction for most people seeing a move like this in a stock that has run up over 1,200% in the last year is to label it. They call it a meme stock, a retail phenomenon, a speculative bubble with no grounding in reality. The expectation is that this is just noise, another volatile spike on a high beta chart that will come crashing down just as fast as it rose. But the reality of what is happening today is far more specific and, frankly, far more interesting. This isn't just a random access surge. It's a powerful move happening on the back of a 1-2 punch of fundamental news. The market is being forced to pay attention, not just to the ticker, but to the business. The first catalyst actually hit after the bell on Friday, and the market is only now, on Monday morning, getting its first full session to digest it. The company reported its third quarter 2025 financials, and to say it beat expectations is an understatement. The analyst consensus was looking for a loss of about 6 cents per share. Instead, Quantum Computing Inc. posted a profit of 1 cent per share. Now, in the grand scheme of a multi-billion-dollar company, a 1 cent profit is tiny, but that's not the point. The point is the direction and the surprise. Even more telling was the revenue. The street was looking for around $100,000 to $125,000 for the quarter. The company delivered $384,000. That's a 280% beat on the top line and a massive jump from the $101,000 in the same quarter last year. Perhaps most importantly for a manufacturing-focused tech company, the gross margin expanded from just 9% a year ago to 33% in this quarter. This isn't just a science project anymore. It's a business that is beginning to show signs of efficient, scalable operations. This is the kind of report that turns heads, proving that the company can generate revenue and it can do it profitably. But that was Friday. The second catalyst hit this morning, adding gasoline to that earnings fire. The company announced today, November 17th, that it is debuting a brand new product at the Supercompute 25 conference this week. It's called NeuroWIMV, and it's a photonics-based reservoir computing system. The key detail here is that it's built in a standard PCIe interface. For the non-technical viewers, that means this is a card designed to be plugged into existing computing infrastructures. This isn't some massive, room-sized laboratory experiment. It's a product. It combines optical computing with digital electronics, and like the rest of QCI's technology, it operates entirely at room temperature. This is the company's core differentiation. While competitors are focused on systems that require complex, expensive, super-cold cryogenic environments, QCI is building systems based on photonics that work right on a desktop. So you have a massive earnings and revenue beat on Friday, followed by a tangible, practical new product announcement on Monday. This is the reality behind today's 13% spike. This kind of volatility is exactly why so many investors are both terrified and mesmerized by the quantum computing space. A stock with a beta of over 3.75 like QBUT is not for the fan of heart. It's not a stable blue chip like Apple stock, and it doesn't have the proven multi-trillion-dollar market cap of a giant like Nvidia stock. It's not even in the same category as the high-growth, high-volatility story of Tesla stock. This is an entirely different class of asset. This is the definition of self-investing. You will not find QBUT as a core holding in a passively managed Schwab Intelligent Portfolios account or a standard issue Fidelity Wealth Management plan. This is a high-risk, high-reward, research-intensive play that retail investors are accessing through their individual brokerage accounts. The explosive volume we're seeing is a clear sign that traders on the Fidelity mobile app, the Robinhood app, and SoFi Invest are all piling in, trying to catch this momentum. It's the kind of stock that lights up the Robinhood stock trading most active lists. The common belief about QUBT and its peers like Rigetti and D-Wave is that they are all just concept stocks valued at billions of dollars with almost no revenue to back it up. And for a long time, that expectation was largely correct. The stocks have been trading vehicles, moving on hype, sector momentum, and government funding announcements. But the Q3 report from QUBT challenges that narrative directly. It shows a company in transition. The revenue, while small, is coming from real, tangible sources. They have an ongoing project with NASA, using their quantum optimization machine to remove solar noise from space-based LiDAR data. They recently completed a significant sale of a security solution to a major unnamed U.S. financial institution, which is a massive validation of their post-quantum cryptography technology. And they are generating revenue from cloud access to their Dirac-3 optimization system. These are not future promises. These are current revenue streams. So what does Quantum Computing Inc. actually do? The company is an integrated photonics and quantum optics company. Put simply, they use light, photons, to perform computations. Their core technology is based on thin-film lithium niobate, which allows them to create photonic chips that are small, fast, and, critically, operate at room temperature. This is the entire ballgame. If QCI can successfully commercialize and scale this room temperature approach, it could leapfrog competitors struggling with the massive cost and engineering challenges of cryogenics. They have their own operational foundry, Fab 1, in Tempe, Arizona, where they are already producing these chips. They are shipping them to early customers and refining the process, all with the goal of moving to Fab 2, an industrial-scale production facility. This is a hardware and services company, not just a software algorithm. This is why a simple online investment search doesn't do it justice. You have to understand the technology they are betting on. For anyone looking at this space, the choice of platform for online investing becomes critical. A swing of 17% in a single day, as QUBT experienced on Friday before today's gap up, can trigger margin calls or blow up an account that isn't prepared. You need a robust system, whether it's the advanced order types on the Fidelity trading platform or the professional-grade infrastructure of Interactive Brokers. Many serious traders prefer Interactive Brokers trading specifically for its speed and access to global markets, which is vital for a sector with international competition. Even the more retail-focused platforms like SoFi are expanding their SoFi active investing tools to cater to this new generation of traders who are comfortable with this level of action. The days of only buying Fidelity mutual funds or Fidelity ETFs in a Fidelity IRA account are long gone for this segment of the market. They are actively managing their own capital, using Robinhood investments for Robinhood fractional shares in high-priced stocks and going all in on speculative names like QUBT. This is a new world of investing sites and investment help where information and execution speed are everything. Now, let's look at the future outlook, because this is where the expectation versus reality framework gets really stark. The biggest risk, and the one bears will point to, is valuation. The company has a multi-billion-dollar market cap on the back of less than $1 million in quarterly revenue. On any traditional metric, it looks absurd. It has also funded its growth through significant dilution, including a $750 million private placement earlier this year. This is not a cheap stock, and the risk of it falling 50% is just as real as the potential for it to double. However, the bullish reality hinges on one single massive fact that the earnings call just confirmed: the balance sheet. Quantum Computing Inc. is not a struggling startup on the verge of bankruptcy. As of the end of the third quarter, the company had $352 million in cash and $461 million in short-term investments. But it gets better. After the quarter ended, they raised another $750 million. This gives them a total liquid position of over $1.5 billion. This is a war chest. This is not survival capital. This is offensive capital. They have explicitly stated that they are now pursuing a mergers and acquisition strategy to acquire customers and fill technology gaps. They are not the prey. They are the predator. They have the funding to execute their 3-year roadmap, to build out Fab 2, and to weather any market downturn without having to desperately raise more cash. This $1.5 billion completely changes the conversation. It means they can fund their R&D, scale their manufacturing, and market their new products like Neurowave without worrying about keeping the lights on. This is what the market is truly excited about. The earnings beat proves the model works. The $1.5 billion ensures they have the time